Our market masters for the day will be Ridham Desai, Managing Director, Morgan Stanley, and Sameer Arora, Founder and Fund Manager at Helios Capital. We'll have more masters actually. We will also be joined in the morning for their take on the budget by Rajiv Bajaj, Managing Director, Bajaj Auto, Shikha Sharma, Managing Director and CEO, Axis Bank, and Ashok Tyagi, the Group CFO at DLF. The other market master I was talking about, Dikshit Joshi, the Managing Director and Head of Equities for Asia Pacific at Deutsche Bank, whom Sonia will be hosting. He will be joining us from the sidelines of the Deutsche Bank Annual India Conference. Also, trading strategies, as always, lined up with Sudarshan Sukhan. All right, actually, our first market master for the morning is already with us, Ridham Desai, Managing Director at Morgan Stanley. Good morning, Ridham. Thank you very much. We woke you up early today. Let's start with the big question. Does the budget have anything to maintain the rally in the markets in the near term? And can it sustain the rally in the medium term?
Yeah, so Lata, I think there are three things in this budget which I think are very positive for the markets. The first is it lends conviction to our earnings growth forecast. So we think that earnings growth, corporate India's earnings growth over the next couple of years will probably be around the mid-20s. So the precise number is 24%. The consensus is somewhere in the mid-teens. And I think this budget has gone a long way in boosting our confidence that the earnings cycle is likely to return sometime later this year. The key takeaway is the increase in investment spending. So the government's capex, both outside and inside the budget, is going up by about 30 percentage points year on year. It's an increase of 100 basis points versus GDP. There are a few other measures as well, but this is the central point with respect to how earnings confidence actually goes up. The second is what the budget does for financial savings. So our view has been that domestic households will put more money to work in equities, probably more than ever before. And at some point in time, maybe even more than what FIs have been putting in the markets, as we have seen over the past few months. And this budget again reinforces that trend. A, by launching a social security net, and B, by attempting to curb gold demand. Especially through this gold bond that the finance minister spoke about. So I think this is a boost for financial savings. That also helps earnings, but it also helps savings into equities. And the third thing is the plethora of things that the finance minister has done to actually ease doing business in India, as well as provide a medium-term framework for corporate tax and probably greater transparency and lesser litigation. So again, that feeds into the ease of doing business. I won't touch upon the minute details here, but I counted as many as 20 items which I think are directly targeted to improving the ease of doing business, including that for FIIs. I mean, for the first time I've seen a budget where a finance minister has not been hesitant to say, you know, these are the things I'm doing for foreign institutional investors. So he has shown great sensitivity to the stock market, which I think is important. So quite a few things out there, the three that I summarize, which make me, which actually reinforces our view that India is in a bull market and will continue to be so.
Okay, let me take your earnings growth argument. Capital spending is boosted by about 70,000 crores. The direct impact is maybe 14,000 crores roads and 10,000 for railways. Which industry will, how does that argument flow? Which industries will immediately benefit?
So Lata, the budget itself is not the only thing. We've been arguing that the government will use public sector balance sheets to actually boost capex. And if you add up the two numbers, because the finance minister also gave us the PSE number, that number comes to close to 1,30,000 crores. So that is actually an increase of 30% year on year. The aggregate capex, public sector, central public sector companies and the central budget is going up 30%. This doesn't count for what the states will do, because mind you, the states now have a greater say in how they are going to spend money. And I think certain progressive states and some states where we have already seen the plans are about to embark on some large capex. I mean, we know the case for, say, Maharashtra, where the new chief minister has a big plan for only the city of Mumbai, and that itself will be a big boost to capex in the coming couple of years. So when you look at earnings, the biggest driver for earnings is the investment spend in the economy, and that's what drives corporate margins up. So given the fact that the government is choosing investment spending over, say, consumption spending, which is what they did in 2009 coming out of the crisis, and that backfired because it boosted inflation and only temporarily improved growth. This budget actually will sustain growth for a longer time. Now, there are provisions in the budget to also help private capex. I don't think private capex is about to turn because private sector profitability is still low, and it will require that to go up, which is probably what will happen in the next 12 to 15 months, and then the private capex will also go up. So that's how it feeds into earnings. With respect to sectors, I think there are two sectors that we are very constructive on in relation to this. One is industrials, where we have gone overweight last year, and private sector banks, where we've been constructive for quite some time. I think public sector banks are not the sector that investors want to buy. And in fact, if there is a risk factor that comes out of this budget, to our view, it is actually the fact that the government has been reticent and continues to be reticent to recap the PSU banks in any major way. So I fear that public sector banks may not be able to participate in the early stages of the next credit cycle. And to that extent, they will continue to struggle. As we have seen, most public sector banks are continuing to struggle to perform.
Okay, that's an interesting point you make. Ridham, hi, good morning. What about the RBI? What do you see the RBI do now? Do you think it will become difficult for the Reserve Bank to cut rates, given that the fiscal deficit targets have been relaxed?
So as I mentioned, one of the risk factors is the lack of recap for PSU banks. The other risk factor for Indian earnings and growth is an appreciating currency. So on a real effective basis, the currency is at over 1 standard deviation above average, and on a nominal basis, it's up nearly 10% against India's trading partners. This appreciation of the currency is certainly a risk factor to earnings, and one of the way of addressing this is to cut interest rates. We actually think that the inflation genie is firmly back into the bottle, and it doesn't change because the finance minister has delayed his fiscal consolidation. The fact is that the fiscal deficit is still going down, and the fact is that the quality of the fiscal expenditure is materially better than it has been in recent years. So I think there is still a very strong case for the central bank to cut rates. We continue to believe that there's another 125 basis points coming this year, so cumulative of 150 basis points, which I understand is completely out of consensus, and therefore we actually think that interest rates are going to go down. It's part of the earnings story that we have.
Ridham, hi, morning. Thanks for joining so early in the morning. Now, post-budget, would you tweak your Sensex targets for the next 12 and 24 months?
So we have not changed our December target. It continues to be at 32,500. As I've said in the past, this has to depend also on what we see other equity markets doing. So by far, the Indian market is offering amongst the best upsides across equity markets in the world from our global macro views. So India continues to be a place where I think you can expect relative outperformance and absolute gains as well. I think the 5-year view is that earnings could compound at maybe around 20%, and the market could do somewhere between 15 to 17%.
Okay. No, Ridham, what I wanted to ask is, immediately, is there anything in the budget to keep the markets boosted, or will the rally continue because all global markets are rising?
Yeah, I think it's more of the latter, Lata. Short-term market calls are always very tricky, and I hate to make them, so much so as my job requires to make them. But I think the global situation is pretty benign, actually. So I think that will feed into Indian equities. The fact is that India offers a very strong long-term story, a potential turnaround in the short run in terms of growth. And if the global equity markets are supported, then there's no reason to believe the Nifty is going to go through any deep correction anytime soon. But that's something that will certainly happen later this year. And to my mind, that will still be a buying opportunity. So we see this is a long-term bull market which is pretty intact.
All right, can you throw some more color then on the kind of sectors and stocks that you're bullish on? You briefly mentioned industrials and private sector banks, but anything more specific?
So we'll focus on sectors. So we like cyclicals, we like industrials, private banks, discretionary consumption. Among the non-cyclicals, my favorite sector is technology. We're still a bit hesitant to buy materials and energy, the global commodity sectors, and we're still underweight utilities, but we'll keep an eye on that. If the government's program starts working, then at some point in time later this year, even utilities could start doing better.
All right, Ridham, some problems actually with the audio, so we'll let you go at that. Thank you very much. I know you have a busy day ahead. Thank you very much for joining us this early in the morning.